Good afternoon, everyone. This is Alex LaBrunerie in Columbia, Missouri, and thank you for joining us and welcome. We thought we would spend about 20 minutes or so over the lunch hour to look at ideas for saving and paying for educational expenses for children and grandchildren. So starting with something and starting with nothing and trying to get the kids to graduation almost debt-free is the goal of most American families nowadays. So we'll look at two ideas that have worked in the past, and thank you. There will be two key parts of this brief talk. One is to look at savings for college for children using the Educational 529, kind of review some of the classic or basic elements of starting out with a college savings plan, and then what are qualified expenses and non-qualified expenses once you make distributions when your child is college age and you're trying to meet those high tuition bills that come in every semester. So we'll look at that. And then the second part of the talk, we'll look at how to use in Missouri, for Missouri citizens, how to use a 529 to pay for private K through 12 tuition. So that's something new that that has just been allowed by law since 2017. So thank you, and we'll continue forward. Between 1977 and 2020, college tuition has experienced an average inflation rate of almost 6.5% a year, and this compounds or accumulates almost a 1,400% increase from 1977 to this year. This rate of change, is quite high, and it's made saving for college even more critical for American families. So this establishes the need and that we have to save for college. You can see in this chart, from back to 1977, when the Bureau of Labor Statistics first started to take note of the tuition rate increases that were affecting us as Americans, and it's been quite high. This is a big number, $302,000 in 2020. To give you a little explanation of the methodology, that is not how much it costs to go to the University of Missouri for 4 years, even in today's high dollar tuition world. This is an aggregate average of private and public schools, and the tuition and the inflation rate brought to bear on them by the Bureau of Labor Statistics. Another way of looking at this, though, as far as getting a child through a 4-year school such as the University of Missouri here in Columbia, would be in the year 2000, tuition at MU, you could get a child through almost for about $20,000. Now it's somewhere between $50,000 to $75,000. So that's in more modern times. In the last 19 years, we've seen that sort of cost increase. And one of the big drivers of this is just simply that running a college has gotten more expensive, and the states have pulled back from funding colleges, so there's been no choice left but for the universities and colleges to increase their tuition, and it's been a vicious cycle. But there's a lot of ways that families can address this with proper planning and savings. So let's look at how this slide here, to save $35,000 for college, if you start with $100 per month when a child is born, or shortly thereafter, and for 18 years, you save $100 a month and earn 5% on that money, you will accumulate just in principal contribution about $21,700 $600. Your earnings at 5% would add another $13,400, and that would, in a 529 account, be tax-free. So this growth here would be tax-free. And you can see you've quietly accumulated $35,000 if you need to over 18 years. If you need, to double that, then start with increasing this to $200 a month, and do this for each child, and you'll be well on the way of creating a solid base base account or principal amount to use when the child's in college. Let's look on this other side, though, of the slide, and we see what the cost of borrowing is for the same scenario. 18, if you wait until the child is 18 and then borrow $35,000, the family will have to pay back, or the adult child will have to pay back $406 a month for 10 years, assuming a 7% interest rate. That would mean the same $35,000 costs the family or the child $48,000, $48,700, instead of just the flat $35,000. So this shows what we call, when it comes to saving for college, you want to start early and stay late. In other words, keep saving, keep adding money, and reviewing the plan each year with yourselves and with your investment advisor or your accountant. The debt keeps growing. Just to take a step back real quick to look at the landscape of our student loan debt in our country, is reached almost $1.5 to $1.6 trillion, and this is as of 2018, and it just is a steady step up. We're up to 1.6 now, and this information on this graph shows us the age brackets, and we actually still see in this little nip here, we still see people at their age 60 still paying back student loans. You see a solid majority are under age 40 here, the red and the blue, but this chart really captures the debt obligations outstanding for student loans, and that is what we want to help people try to avoid by saving for their colleges, for their kids' colleges early. Putting time on your side is essential. The miracle of compounding interest can really work, whether it's when you're looking at long-term savings and investing. What we have, if the same child born this year is as an infant, if can grow to earn, doing $100 a month, will grow to $40,000 by the time he or she graduates high school. This is at a 6% interest rate, so it's a little higher than the previous chart we looked at. So that's why you see a little higher value here, 40,000 versus 35,000. But what I want to point out to you is that the cost of waiting per year is $4,000. So this, again, hits on how important it is to start early, because that lets compounding interest and time work to your advantage. The average, if you look for 5 years, waiting till the child is 5 years old and then start, you've lost $16,000. And we'll have to catch that up or borrow it. So let's look at how 529s work real quick. So the details outlined here on this chart. 529s, any earnings that grow are tax deferred, and when you have a qualified distribution to pay out educational expense, that distribution is free from federal income tax. It's important to note that it's not that there is no federal tax deduction or adding to a 529. Certain states like Missouri do have a state tax deduction, which we'll go into. However, there is no federal tax deduction. There is tax-free gains, however. Annual gifts are tax-free. So 529s can be used by grandparents for estate planning purposes or for gifting, help working with one's attorney or a tax advisor. Sometimes a very aggressive gift planning strategy can be used with 529s to get money to grandchildren or even to adult children. Importantly, on the 529, the beneficiary can be changed. In the old days, before 1996, which is the year 529s became law, the common way of saving for college were UGMAs, or Uniform Gift to Minors Acts. And what those accounts do are the child is the owner of the account and the parent is the custodian. And when the child reaches 18 or 21, legally has the rights to gain access to the account. UGMAs are good for gifts for buying cars or something like that, or if the child has their own money that they've earned at a job, an UGMA account is still useful. But for saving for college since 1996, 529s have been the choice by many parents because the parent controls the money. So if the child does not go to college, the money can be moved to another child in the family or just controlled by the parent or grandparent. That's this point here, the participant or owner controls the money at all times. Contributions are not to a 529 are not limited by income. So they are limited. The deductions for the state of Missouri have caps, $8,000 per taxpayer, and I think $16,000 for filers who are joint households, joint filers. There's no age limit for the beneficiary, so a 60-year-old daughter could be the beneficiary, and they really don't have a lot of impact on financial aid. The financial aid formulas have a lot to them, and I would not advise not saving in a 529 on the idea that you're going to miss out on some financial aid. That's oftentimes just means more borrowing. So financial aid does. So let's look here. This map of our country shows which states have tax parity that allow tax deduction and also allow citizens of their states to invest in 529s outside of the state themselves. And you can see there's just a handful, and Missouri is one of the states that gives us a tax deduction and also lets us invest in other states' 529s if we want to. The yellowish gold states have no state tax benefit, and the gray colored states like Colorado and Utah here have tax benefits, but the citizen must use the in-state approved plan. So that's important to note. Let's look at how much the Missouri state tax really helps Missourians on their tax bill each year. As mentioned, the maximum for joint filers to deduct a contribution to a 529 is $16,000 in Missouri. And with our rate of almost 6% or 5.9 marginal tax rate in Missouri, this works out to a $17.70 tax savings on $25 a month or $300 a year. And $50 a month saves a Missouri taxpayer almost $35.40 a year. $100 a month, like in our example, which is a good amount to start with a newborn, is $70.80 a month. If you go to the maximum and do $16,000, the state tax savings is $944 approximately. So this is every bit helps when we're saving for college, and the tax deduction in Missouri is certainly a nice help. So once a child, it's a very common, almost rites of passage in our country now for many families. It's the drop-off day at freshman year at college, and mom or dad take the child to college and drop her off for her first year in college. And at that point, mom and dad have to start figuring out how to pay for the next 4 years for their child. And if they, in their 529, they're going to have funds to pay for the college expenses, but they have to keep accounting of what's a qualified expense and what is not. And there's tuition and fees are qualified expenses. Computer and internet access are qualified expenses. Room and board are a qualified expense that allows for tax-free withdrawals. If it's off-campus housing, that has to be on parity with what the on-campus housing by the school itself would be. So special needs equipment qualify for a tax-free withdrawal from a 529, and so do books and supplies. So these are all qualified expenses. There are several non-qualified expenses too, and these are expenses that you would not want to draw from a 529 to pay, because you would not have the tax-free distribution by the IRS, and that would mean you owe taxes on any gains, and there's a slight tax penalty of 10% too. So keeping track of these expenses, qualified and non-qualified, is important. Application fees, testing fees, college preps are non-qualified. Health insurance, transportation and travel costs to and fro to the school are not qualified, and any extracurricular activity fees are not. I'd also like to note that scholarships and tax credits need to be accounted for as non-qualified expenses in their own way. This American Opportunities Tax Savings Credit is something that many families qualify for. It's up to $2,500 in credit on your taxes for tuition paid, as long as you meet the income requirements by the IRS. Scholarships. If your child's tuition bill is $5,000 and she gets a $2,000 scholarship, you cannot withdraw $5,000 and have that full $5,000 treated as a qualified expense. That $2,000 comes off the top, and you only need to pull off, are required to withdraw $3,000. So you can't count that scholarship, luckily, if she gets one. So let's move on now to investing for private school tuition. And this is something that is new as of 2017. The tax law of 2017 made this possible for use on 529 contributions. So this has to do with private K through 12 school tuition. So that would be parochial schools, it would be private schools here in Missouri, for grade schoolers on up to high school private schools. So the first thing a parent does is who has a child in a private school, K through 12 school, is open a 529 savings account. They then fund that same, if their tuition is $10,000 or $3,000 a year, whatever their tuition is for that year, they deposit that amount into the new 529. So let's, in this example, just say it was $10,000. So, and say that in the money sits in the account. It should be invested very conservatively, and then because what we're going to do here is withdraw that $10,000, and we're going to send it to the private school in this example, and we need for that money to be safe, because in 30 to 60 days we're going to turn around and send it to the private school for the child's tuition. So next step here is request distribution for same amount, and it can go directly to the school in most cases. If you make the distribution to yourself, you just need to keep careful records and then write a check for the tuition for your child's tuition through your at the K through 12 private school. So following this, in Missouri, you would save on $10,000 over about $600 a year in state taxes. So that's a nice savings for basically arranging the payment of the tuition a little differently. It's important to discuss this, with your school's registrar and with your advisor. We have done these transactions for clients here in Columbia, and are open to any questions you have on that. But also consult with your tax advisor as well if you have questions on taxation. So, getting started, again, let me review the steps on this, how to open up a 529 for your child, whether you have a tuition bill due or whether you have a newborn. Step one is open up a savings account. The Missouri plan is called the MOST, and it is a direct to investor plan, no financial advisors. If you would prefer to use an advisor, the top rated plan by Morningstar in 2019 were the Illinois Bright Directions or the American Funds Virginia plan. There are several other high quality plans in the country, and you can research that or talk to an advisor. Step two, start automatic monthly contributions that are fit into your budget, and make a note to review those annually for opportunities to increase. Invest in goal appropriate investments. So very important. For college, you may want to be more aggressive for younger children so you can earn that 6% return that you need to grow the money nicely. But gradually get more conservative as your child gets closer to college, because you don't want to risk being caught in a market downturn the year your child goes to school and you have to make a withdrawal and the market is down. For private school tuition, I think you'll almost always want to use conservative investment choices, because you'll be making withdrawals within a matter of months after the deposit of your 529 account. Work with your accountant. It's important to get these deductions in Missouri. Your accountant has to know that you made the contributions. So keep records and keep notes, and when you see your accountant at tax filing season, let her know what you've done on the 529 front. And then if you're a parent with a child in college now, make sure all your withdrawals are qualified and therefore free from federal tax. Step 5 is go ahead and pay for college and private school. And that wraps up our brief talk today on 529. There are 3 major kind of landmarks in a family's financial journey together, and one of them is educating the children of the family. I think the other is creating retirement income for the parents when they are older, and I think the third is creating long-term care expenses for the very late years. So those are the 3 major financial events that a family experiences together. And we've been helping families here in Missouri Save for College for over 50 years. We very much enjoy that service, and we offer advice on it. So if you have any follow-up questions, please let us know. Saving for college can look a little scary when you look at those numbers, but with hard work and planning, it's not insurmountable at all. Also, if you wanted to let you know, in our own office here today, Leslie Wilbers gave birth to a new baby, so Savannah Rose, and she is 6 pounds, 12 ounces. So Leslie and her husband will most likely be starting at 529 early, but we wish everyone a trick or treat, happy Halloween, and thank you.